Hello everyone, I'm Shivang Mehta. In this session, we are going to analyze ICICI Prudential Fixed Maturity Plan Series 88, 1858 Days Plan D. It is a closed-ended debt scheme, a relatively high interest rate risk and relatively low credit risk. So benchmark, basically the risk appetite of this scheme is moderate and it is launched by ICICI, which is trusted for over 25 years. So take advantage of interest rate fluctuation. This scheme you can take advantage of interest rate fluctuations, and it is suitable for moderate rate mod, mod for the investors with moderate risk appetite. So before we get started, please subscribe Yoshop channel for analysis of new bonds, NFO, NCD, IPO, ETF, and many more. Also visit yoshop.com and use coupon code YO100 for flat rupees 100 discount on all products and free 1 year GST and ITR e-filing services. So let's go ahead and analyze this one. So fixed maturity plans, it is very important to understand concept first. So fixed maturity plan is the fixed tenure mutual fund scheme that invests its corpus in debt instruments maturing in line with the tenure of the scheme. The tenure of the fixed maturity plan can vary between a few months to a few years. So fixed maturity plans are ideal for those investors who need returns higher than a regular FD but can accept the frequent NAV fluctuations. So compared to equity schemes, fixed maturity plans are low risk return investments basically. So scheme details. So the new fund is opening on March 10 and it closes on March 14. The corpus of the scheme will be divided into units having an initial value of rupees 10 each. Units can be purchased during NFO period only. Minimum rupees 5,000 and multiples of rupees thereafter. This is the minimum amount of application in this NFO. Minimum switch-in amount is rupees 5,000 and any other amount further. Scheme objective, liquidity and benchmark. So the investment objective of the scheme is to generate income by investing in the portfolio of fixed income securities, debt instruments maturing on or before the maturity of the scheme. However, there can be no assurance or guarantee that the investment objective of the scheme could be achieved. And liquidity, so no redemption, repurchase of units shall be allowed prior to the maturity of this close-ended scheme. So benchmark is CRISIL medium to long-term debt index for 1858 days. The composition of aforesaid benchmark is such that it is most suited for comparing performance of the scheme. Plan and asset allocations. So plans, two regular and direct plans are available in this scheme. Also, IDCW plan, which is income distribution come capital withdrawal option, is also available in this scheme. Before we used to call it a dividend option. So on time to time you can get returns of this scheme if you opt this plan. Default plan will be growth option. And coming to the asset allocation, debt instruments including government securities will be allocated 80 to 100%, and money market instruments maximum 20% will be allocated. Coming to the instruments, so corporate deposits, corporate commercial papers and commercial deposits will be allocated 0 to 5% of the scheme, and 95 to 100% will be allocated to government schemes, SDLs, treasury bills, 0 to 5% to tri-party repo and reverse repos in government securities. Coming to the investment strategy, so the scheme will invest in a basket of permissible securities maturing on or before maturity of the scheme. The scheme will invest in securities with a view to hold them till the maturity. To that effect, the scheme will follow a buy and hold strategy to this investment. Coming to the benchmark performances, so benchmark CRISIL medium to long-term debt index is given. In long term, it has given 7.7% returns in 5 years. In 3 years, it has given 8.7% returns. So these returns are above the fixed deposits that we have banks. So there is difference of 3 to 4% in returns compared to the present FD returns. So inception of this index was Jan 1997. So we have sufficient data to analyze performance of this benchmark. pros. So pros of investing in these schemes are minimal interest rate risk. Fixed maturity plans are least exposed to interest rate risk because the fund manager will normally hold the instruments till their maturity. Also, fixed maturity plans generally invest in securities with higher credit quality so that credit and liquidity risks are minimized. Low cost, as the investments are made in line with maturity of the fund, there is no buying or selling securities in the scheme. This reduces the cost of the scheme. And low tax investment made in fixed maturity schemes are above certain period allow an investor to take advantage of indexation benefits. So basically, indexation is a process where you can take advantage of rising inflation in the economy. So the effect of inflation on your returns are subtracted before calculation of tax. Cons, cons of FMP. Though FMP offers several advantages, investors should also be aware of the drawbacks. Unlike the bank FPs, where one can opt for premature withdrawal by paying some penalty, the exit from FMP is very typical. Though these units is listed on stock exchanges, most counters are virtually illiquid. Secondly, though the FMPs are relatively less risky, investors should not treat these as dream products that offer high return with zero risk. While the structure eliminates the interest rate and reinvestment risk, the credit risk still exists. So you should consider this all factors before investing in fixed maturity plan schemes. So should you invest in this scheme or not? This is the most important question. And right now, considering the current monetary policy conditions in world economy, when inflation is rising, unemployment has gone over 5%, economies are on the path of growth, and interest rate hikes by central banks are on expected lines. If you have sufficient liquidity and if you don't want to take risk of investment in capital markets, then this is the right time to invest in FMPs. In long term, these schemes won't be able to give inflation beating returns considering its historical performances. Therefore, all factors should be considered before investing. So now you should consider your long term wealth creation vision and risk appetite and plan to invest in the scheme or not. Thank you.